Okay, Assalamualaikum warahmatullahi wabarakatuh. Now I would like to explain about one questions that relates to transfer pricing. This is actually past semester questions June 2015. Okay, look at the questions. The Central Division of AMB Bhd manufactures premium quality plastic board sheets for local industrial customers. The products are currently sold at a standard price of 50 ringgit per unit. Okay, 50 ringgit per units. And currently the division plant's capacity is sufficient to meet the order from regular customers, which normally reach 6,000 pieces per month. The spare capacity currently available is limited to 4,000 pieces. Spare capacity means extra capacity. Okay, extra capacity. Summarized below is the financial results of the central divisions for the months for the most recent month. Okay, they give a sales revenue 300,000. So from here we can calculate, we can check selling price, how much selling price per unit. You divide by 6,000, then actually you will get 50 ringgit, which is equivalent to this selling price stated under second sentence just now. Okay, then variable production cost 162,000, you divide by 6,000, you will get variable production cost for one unit, which is 27 ringgit. And then fixed production cost 54,500. Selling admin cost, they put in bracket including 1 ringgit 60 cent commission per sheet. So total is 29,600. That means selling and distribution and administrative cost is mixed cost. Okay, this is mixed cost. So mixed cost means it contains both variable and fixed portions. So variable portions in terms of a commission, 1 ringgit 60 cent, you multiply by 6,000, then you will get 9,600. So to calculate fixed cost, you just deduct the value, 29,600 minus 9,600. So fixed portion is 20,000. Okay, next paragraph. AMB division located in Amanusa is looking for a supplier that can consistently provide 3,400 pieces of plastic board each month at competitive price. The division is planning to manufacture modern design display rack that would require the use of 2 pieces of plastic board. That means 1 unit's display rack requires 2 pieces of plastic board. Therefore, the ratio is 2:1. The manager of Amanusa division target to sell 1,700 display rack. Okay, how much they sell? They sell at 230 each. And the estimated cost related to the sales and production of the display rack are stated below. Variable production cost 112, fixed cost 47 ringgit. So in this case, Amanusa division is actually our buying division, buying division. And then central division is your selling or giving division. So remember, for selling division, transfer price will be recorded as revenue. So increase in transfer price will result in an increase in net profit for selling division. Whereas for Amanusa division, for buying division, transfer price they will record as expenses. So when transfer price increase, they have to pay more. Therefore, their net profit will reduce. Okay, now we read further. The projected variable production cost shown above include 80 ringgit cost of plastic board sheet. The manager of Amanusa division is willing to purchase the plastic board from central division at 40 ringgit per sheet. Okay, the central division will not incur any sales commission for the internal sales. That means central division will incur commissions for external sales only. Okay, so if you look at this paragraph, okay, if you look at not this one, okay, previous paragraph. If we look at previous paragraph, okay, not okay, never mind. Okay, if you look at second table just now, variable production cost is 112. Okay, variable production cost is 112. That means included in 112 is actually 80 ringgit cost of plastic board. Alright, now look at the requirements. Requirement A, determine the net income of the selling divisions. Okay, determine net income of selling divisions and buying division if the transfer is made at price suggested by Amanusa division. Okay, so Amanusa division suggests 40 ringgit per unit. Okay, so to answer first requirement, you calculate sales revenue. This is your external sales. Okay, this is your internal sales. You sell to external market 6,000 pieces at 50 ringgit each, and then you transfer to Amanusa division, okay, 3,400. Remember, to produce one unit display rack, Amanusa division will buy 3,400 two pieces of plastic board. So if they want to produce 1,007, they buy double the amount. That means 3,004. So you bring down this value, because under central division we record as expenses as a revenue, but under buying division we record as expenses. Then we calculate variable production cost for central division. This one is actually commission. Commission you calculate based on external sales only, but variable production you calculate based on 9,400 and both amount. And then for Amanusa division, plus other variable production you calculate based on demand. Then you calculate contribution margin minus fixed cost. Okay, fixed cost, this one we copy from first table. And then fixed selling admin we calculate earlier, 20,000 for central division. For Amanusa division, they give us 47 ringgit fixed cost, so we multiply by 1,007. Okay, so finally we will get net profit for central division 98,100, Amanusa division 120,700, and AMB division 218,800 ringgit. So first requirement complete. Alright, then we move to second requirement. Discuss the effect on the division's profit and profitability of the company if the goods are transferred at current market price. So at current market price, currently you sell plastic board to outsiders at 50 ringgit. Now you change your transfer price equivalent to 50 ringgit. So when you change your transfer price, that means your internal sales you need to change. And then later you will bring down the value, so definitely this figure also you need to change. And then you need to calculate again your contribution margin as well as profit. Okay, let's say we already calculate. Look at the one with in red color, the one in red color. So we change the value. So question asks you to discuss the effect, so you compare with your first requirement. Okay, so since central division is selling division, when transfer price increase, net profit for central division also will increase. So if the company increase transfer price from 40 ringgit to 50 ringgit, profit for central division will increase to 132,100 ringgit. And then Amanusa division, they have to pay more. Okay, therefore when transfer price increase, their profit will reduce to 86,700 ringgit. However, for the company as a whole, for AMB Bhd, profit will maintain at same value. Okay, and then this is third question, key features of good transfer price. And then last question, if Amanusa division buy from external supplier, what happened to the profit for each division and company as a whole? So if they buy from external supplier, they have to pay extra. They pay at 84 ringgit. Okay, and then company's profit will be affected. Why? Because now central division, profit for central division reduced to 53,900. Furthermore, this division operate at 60% only, okay, below their maximum capacity. So that definitely will give effects on overall company's performance, whereby profit for companies as a whole will reduce to 167,800 ringgit. Okay, that's all.